All right, let's dive into Medtronic's latest earnings release, because this one is a real head-scratcher. On the surface, things look great. But Wall Street? Well, Wall Street saw something completely different. We're going to break down exactly what happened, and more importantly, why.
So, here's the big question, the central paradox we're tackling today. Medtronic comes out, posts a solid quarter, beats what analysts were expecting on pretty much every key metric, so you'd expect the stock to pop, right? Nope. It actually dropped over 3%. So what on earth did investors see that spooked them so badly? Let's figure it out.
Okay, first up, let's look at the headline numbers. These are the figures that, in a normal world, should have had investors cheering. And I mean, just look at this. On paper, it's a clear win. Adjusted earnings per share came in at $1.36, beating the consensus. Revenue was over $9 billion, a good $120 million more than expected. And that organic growth number, 6%, that's really strong. That's the kind of performance that usually gets a stock moving in the right direction.
And yet, this happened. A drop of 3.1% on the day of the announcement. This is the disconnect right here. It's clear that investors looked right past that solid beat and honed in on something else entirely.
So let's hear the company's side of it. During their earnings call, management painted a really optimistic picture. We're calling this the push narrative. It's all about a pipeline packed with innovation and the momentum they see building for the future.
And this chart just says it all. Their cardiovascular business was the star of the show, growing a fantastic 11%. But here's the wild part. Look inside that number. Cardiac ablation solutions were up 80%. That is just explosive. This is all being driven by their new pulse field ablation, or PFA technology, which is a game changer for treating atrial fibrillation. They are absolutely crushing it and stealing market share.
And management is really betting the farm on what they're calling 4 generational growth drivers. You've got that PFA tech we just talked about, then their Symplicity Spyral for hypertension, Altaviva for urinary incontinence, and of course the Hugo surgical robot, which is finally starting to get its footing in the US. They see each of these as a potential billion-dollar-plus opportunity. It's a huge part of their story.
And really, this quote from the CEO just wraps up their whole argument in a nutshell. They truly believe this pipeline of innovation isn't just a one-time boost, but the engine for real, sustainable, long-term growth. It's a very compelling story. But as we know, it's only half the story.
Now for the other side of the coin, this is the pull narrative, the one that dragged the stock down. This is all about what worried investors, the guidance for the future, and some serious concerns about profit margins.
Okay, this is the absolute key to understanding the market's reaction. After that really strong third quarter, Medtronic didn't raise their full-year guidance, they just kept it the same. Now, to you and me, that might sound fine, but to an investor, that's a massive red flag. Why? Because it implies that even though sales are better than expected, profits aren't going to be. That screams that costs are rising and that profit margins are getting squeezed.
And here's one of those costs in black and white. Management specifically pointed to a $185 million headwind just from tariffs this fiscal year. That's not a small number. It's a real significant hit to their bottom line that even a great innovation story can't completely hide.
So there you have it, the incredible push from this amazing innovation pipeline versus the very real pull of these margin concerns and lukewarm guidance. So how do we balance these two forces? What's the takeaway here? Well, here's our take.
Now, before I give you the rating, let's just be super clear on what this term means. When an analyst says market perform, they're not saying the stock is going to go nowhere. They're saying they expect it to perform pretty much in line with the overall market, like the S&P 500. It basically means the good stuff, the long-term potential, is being balanced out by some very real short-term challenges.
So our rating for Medtronic is market perform. Look, the long-term story here is genuinely exciting. Those 4 growth drivers could be transformative. You can't ignore that. But the market's worries about the margins and the guidance are completely valid, and they're creating a headwind that's just impossible to ignore right now. The bull case and the bear case are in a dead heat, which makes it really tough to argue for a more aggressive rating one way or the other.
And of course, we have to end with this crucial reminder. This analysis is for informational purposes only. It is not financial advice.